what sort of unintended consequences could we see, the fallout from these sanctions, and how would that affect markets?
Well, I'm thinking back to 1998, and I think this is really looking more and more like that, where that was the last time Russia defaulted. And what we need to remember is that banks' relationships are complicated webs, and if one payment can't get made, then another can't get made, and another, and the knock-on effects are huge. It's sort of like, I don't know, have you ever put your back out or had a torn muscle, and then you realize your whole body gets thrown out of whack by that one thing. So somebody, I think, is going to get left holding the bag, because right now very few people dare to buy Russian goods. Russian oil is not finding buyers, even though there's 20% discounts. It's not because we can't buy Russian oil, but buyers and shippers and insurance companies, they don't want to, get caught up in the sanctions somehow. So I do think an event like LTCM is possible, and so that's why we think that actually we're in the middle of a cyclical bear market, exactly like 98 was.
I really understand your back example too well, but given the situation then and the potential knock-on effects there, how do you protect yourself? Is there a way that you can switch your assets and your allocations in order to hedge for this?
I don't think you can hedge, but what we are advocating is moving some of the blue chip technology exposure that's done so well over the past 10 years into commodity companies, because even if inflation is going to come down, it's not going to go back to pre-COVID levels, and there will be a scarcity of commodities in this uncertain world. And then biotech we think it's got great value. It's back to pre-COVID levels. And private equity is the kind of thing that you have to hold for the long term, so you don't panic in times like these. And I'd also say equities and economies that have a strong track record in defending property rights, that will become more important, shareholder value. And so that would take you to places like Switzerland, Sweden, Singapore, also the United States.
Mark, moving to China, of course, the MPC beginning this weekend. Are you expecting any big stimulus news coming out of it, or is it just kind of more of the old playbook, infrastructure investment through these local government financing vehicles?
Yeah, just as you said, no, not expecting much stimulus, and the special bond issuance, so the infrastructure can be accelerated. We do see that, but I think that people who are looking for a big monetary and fiscal easing are going to be disappointed by that.
Mark, I am just wondering, though, in terms of some of the pressures that are really doubling down on Beijing at the moment, where do you see the policy priorities coming out of the MPC, and are any of these themes investable? Because it feels like investors have been kind of really pretty disappointed in the level of stimulus that have come through so far, and of course the systemic issues domestically that remain problematic, like the property sector.
Well, I think they're walking a fine line between trying to move toward common prosperity, a more balanced society in terms of equality, and at the same time, allowing a certain amount of economic growth. So it'll be interesting to see what the GDP growth target is for this year, if there is one. We don't have a strong view on that, but I suspect that 5.5% is unrealistic. And so between the common prosperity and the GDP growth, my sense is they are leaning more to the common prosperity. Inherently, that is, it's great for people. It means there's going to be nice parks and clean air and more free time, but it will also mean a lower return on equity. So the Chinese stock market over the next 10 years, it won't be like the NASDAQ was over the last 10 years, or the Chinese stock market itself was over the last 10 years. It'll look more like the Nikkei or the DAX and reflective of a more communitarian society, a more industrial economy.